Good day, folks. Natural gas in at 303, out at 335. That's our trading position, and we're flat on natural gas now for first time in quite a long time. So we got in near the bottom. We did have some earlier positions, but we've covered those. Our last entry position was at 3.03, and we got out at 3.05. Now I've just put those arrows in to indicate the trades, but let me just move this away to show you why we got out of this trade. Now this is a 4-hour chart at Black Bull markets, and we're tracking the Henry Hub futures, the front month futures. And what we got a few candles ago was this tweezer top, and that's what instigated us to get out of the trade. As we formed that tweezer top, I zoomed into the hour chart, made sure that there was a tweezer reversal on the hour chart too, and we exited the trade long before it got to the bottom of that candle. We got out at 3.35, actually 3.36. The very next candle was a star doji followed by a spike high doji, which took us above the tweezer top. But notice critically that we didn't close above that 4-hour tweezer top on the 4-hour chart here, and that candle collapsed right back down. We're now trading at 3.33, and I expect this will probably continue to move lower. Let's go back to the day chart and have a look what that looks like. And once again, let me move that away. You can see not quite a tweezer top, but a slight reversal on the day chart there too. Let's switch across to the price directly from the NYMEX, and we'll bring our familiar old chart back here again, and you can see where we are now, reaching the top of the range. Remember, above $3, and particularly towards $3.50 like we are going now, natural gas is pretty expensive. This is the top of the sort of average range. We may extend into 4, maybe 4.2, but generally natural gas trades between $2, let's say $4 for posterity, but generally about $1.80 to about $3.50 or 80, somewhere around there. We're very, very close to the top of that range, and caution is now needed. Let's go back to the 4-hour chart, and then I'm going to switch to the spot price at Pepperstone and show you what that looks like. Here's the 4-hour chart, so just curling over after that tweezer top, followed by a star doji and then a spike high, all looking quite negative and not getting through the top of this order block. As you can see, we did spike through it 3 times, but we have not managed to close above it very crucially. And you can see we've tried 3 times and now failed. On this candle, we haven't even tried one more time. We just actually rejected straight from inside the order block. Let's have a look at the spot price at Pepperstone, and you can see a pretty similar sort of pattern. This is the 4-hour chart at Pepperstone. There's the tweezer top, there's the spike high, the little star doji, and just beginning to roll over right now. Looking at this on the day chart, remember this is a continuous or spot price, so it's different. It's not the futures price. But once again, just reaching the top of that range. Right now, we're still above the 20-day moving average. There's no reason to be bearish. I'm not selling, but I'm watching to see what happens at this crucial juncture. Although I am long on the continuous contract here at Pepperstone, majority of my trading has been on the futures at Black Bull markets. By the way, if you want to join Black Bull markets so you get free trading view charts, there's a link below, and you can follow exactly the prices that I'm trading if you'd like to do that. It's an affiliate link. I do get a little bit of commission if you should so open an account. So switching this back to the 4-hour chart, you can see just rolling over here on the continuous at Pepperstone, and also the front month here at the Henry Hub. I want to show you one more thing on the COT report, or the report from barchart.com. One thing I want you to observe is that the price for this time of the year has almost caught up now with the average pricing, that big drop into December for the average the last 5 years, and we've now reached up into a very similar sort of level. So we're not overbought or oversold compared to the average, at least. Let's have a look at the COT report itself. Look at the commercials, long 649, short 500, relatively balanced, actually reflecting where we are on this price chart above. So no real sort of leaning one way or the other. On the producers, 248 long, 264 short. The additions slightly more to the short side, so perhaps gearing up for a longer trade here. And then the managed money, these would be institutions and banks, people that trade natural gas for a living in big volume. 169 long, 242 short. So the managed money, the hedge funds and so on, institutions leaning pretty much to the short side. So that might be an early warning that the hedge funds are shifting. Non-commercials, 211 long, 363 short. These are hedges, as are the swap dealers, 203 long, but only 39 short. So disparity between those two. They're expecting this market to go short, very heavily weighted to the long side. And then the other reportables, generally regarded as the retail traders, people like you and me, 42 long, but 120 short. So retail and the managed money and the non-commercials, perhaps hedges, all leaning towards the short side, whereas the others sort of pretty much balanced. So not a lot of clues from there. However, I think the important takeaway is that we have reached, or almost reached, the average price for this time of the year, going back over 5 years. So folks, I hope you found that useful. I don't have any positions envisaged right now, but if we get a decent dip or a decent rally, I'll look to either buy or sell. And right now, I think we're near the top of the range, so a sell is more likely. If we get a rally up into about 3.8, I'll consider it there. If we get that, I'm not sure we will. Looks like we may not. And particularly if we get up to about 4 or 4.2, I'll be looking for some decent shorts there. My buying levels, if I were to go long, let's go back to the day chart at the Henry Hub to give us the basis for this. You can see we're forming a small sort of trend line here above the 20-period moving average. We've got support below us at this line that I've got drawn in the top of the triangle, and it's quite conceivable still that we could get all the way back down to the top of this triangle breakout level, and that could take us back down to about 2.8 or 2.9. It's tempting to go with the shorts right now, but looking at this bigger picture, we certainly seem to have a breakout out of a triangle consolidation, and the direction for now is long. I'd rather be waiting for the dips to get back long again at this point, but I'd like some decent dips to get into, not at this current price above $3, $3.30. As I said, if we get up to 380, let's go to the weekly chart. It's the 200-week moving average, and that will certainly form a point of resistance. It's actually at 387 today, so somewhere up in that region would be the next point to get out of a trade. Notice that we'd have to actually break above that previous swing high to get there, and that will probably get a lot of people long and bullish. It'd be a perfect time for this to reverse at about 380, 385, 388, something like that. If you enjoyed this, please give us a like and subscribe if you so care to do so, and I'll see you in the next video. Take care.
Bad gas kings, we trade with grace. It'll make a smile, lights up the place. Market swing, but we hold our base. Double bottom strong, we're in the chase. Click and clack that online race. Charts go wild, but we own the space. Resistance broke, no time to waste. Rocket fuel, let's up the pace. To the moon.